Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 383 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about real estate investing, and specifically the choice between directly investing in real estate and investing in real estate investment trusts or REITs, right? And I think that this is a very common discussion to have and something that we should really think about, especially in this world of real estate investment and the high costs of potential investment in real estate. And so I really think that this is worth our time to discuss. And we'll talk about some of the pros and cons of doing either type of real estate investing, and then what I think you should do based on where you are at in your financial life. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, I don't know about you guys, but it's hard to go on to TikTok or to Instagram or whatever else and not be bombarded with any number of get-rich-quick schemes, right? Any number of things that, seem easy in the eyes of whoever's trying to teach you how to do it. And if you know me, you know I'm not about, get rich quick. I'm about slow and steady wins the race. I'm about building things over a long period of time, right? Almost every time you try to get rich quick on anything, it's going to come back to bite you. And one of the biggest things where people think that they can get rich quick is real estate investing, right? They think that, they can use all of other people's money and they can use all this leverage and do all this fancy stuff to get to this point where they're making all this quote unquote passive income and they get rich by doing nothing but just, transactions. And I don't want you to get me wrong. There are people who have been extremely successful at, being highly levered in real estate and doing things in a way that I would never suggest that any of you guys do, right? But there have been far more than those who have been successful have failed, right? Far more have failed. Far more do not get to that point where they are successful. They do not reach this point of making a lot of money, making passive income, being, successful in real estate. And I think that part of that is the get rich quick version of things. But I think another part of that is that they felt like, doing it the way that they did it was the only way that they were going to be able to invest in real estate. And that's just wrong, right? That's just incorrect. It is not the only way that you can invest in real estate. Now, even though I'm going to give you another alternative, you have to understand that these alternatives could not be any more different than, than I'm going to lay out, right? These alternatives are extremely different. Now, they do the same thing in essence, right? They're allowing you to invest in real estate one way or the other, but they do it in a very different way and with very different outcomes, okay? So let's just jump right into it. Again, we're going to talk about direct real estate investing versus real estate investment trusts or REITs, okay? So we'll just start with direct real estate investing, okay? With direct real estate investment, you buy a specific property or a piece of one, such as an apartment complex, a shopping center, so residential or commercial real estate. And direct real estate investors, they make money through rental income appreciation and profits generated by any business activities that depend on the real estate, right? So you make money based on the fact that somebody's paying you rent or the real estate's going up in value or whatever, right? Now, One benefit of investing in physical properties is the potential to generate substantial cash flow, as well as the ability to take advantage of numerous tax breaks to offset that income, right? This is very true. Okay, obviously, if you're getting paid rents for something, of course, that can be very beneficial. So, for example, you can deduct the ordinary and necessary costs to manage, conserve, and maintain the property. Another large tax break is for depreciation, in which you can deduct the costs of buying and improving a property over its useful life, right? And you can lower your taxable income in the process, okay? So that can be extremely beneficial when it comes to directly investing in real estate. Now, of course, there's also the prospect of price appreciation, and boy, have we seen plenty of that in the real estate markets of today. Now, while the real estate market fluctuates as the stock market does, property prices generally increase in time, so you may be able to sell at a higher price later on. Almost always is real estate going to go up in value. Now, this doesn't say just go and buy as much as you can because it goes up in value, because that would not be prudent to do, but ultimately, you can expect long-term price appreciation. And the way that people think about real estate in this regard, I think, is flawed, right? They think about long-term price appreciation in that it only goes up in value over time. And I agree that if you look at the value of your house today and then the value of your house 5 years from now, the value of your house 5 years from now is likely to be higher, right? But you can do the same with the stock market, right? But the difference between your house and the stock market, and the argument that everybody always makes is that the stock market does a lot of this, but I know that real estate's just going to go up over time. I don't think that's valid, right? Because the value of real estate doesn't just go up over time. You only get quotes on it very, very far away from one another, right? Whereas with the stock market, you're getting second by second fluctuations in price, right? You're getting all these securities bought and sold at any given time. Real estate is a far less liquid market, right? And it is a market where you don't have just these major indexes and these individual properties. You don't see their values at a moment by moment basis, right? So yes, they are going to appreciate in price over a long period of time, as a group, but don't get that confused with the fact that the stock market fluctuates in the short term, because so do real estate prices. Now, another perk of direct real estate investment is that you have more control over decision making than you would if you invest in REITs. For example, you can select only properties that match your preferences for location, property type, and financing structure. You can set rental prices, choose tenants, and decide how many properties to buy. You can also refinance your mortgage when interest rates drop, or tap into your home's equity through loans, credit lines, whatever. I'm not suggesting that you do so. I'm just saying that all those things are possible when you directly invest in real estate. Now, what are some cons of direct real estate investment? One of the main disadvantages of direct investing in real estate is that it requires a significant amount of time and energy, right? And this is something that a lot of investors, one, don't have, and two, don't want to have, right? They don't want to spend a bunch of time on their investments. They would rather spend as little time as possible on their investments and just pour money into them over time, right? That's why the stock market and index funds are so beneficial to people and so useful to people, because you can just close your eyes and pour money into a total stock market index fund and make a lot of money over a long period of time. But you can't do the same thing when you directly invest in real estate. It's just not possible. Now, you have to deal with tenant issues, maintenance emergencies, and your liability if there are any accidents on the property. Now, another big disadvantage is financing, right? Many investors need to take on a mortgage or some other type of financing to pay for real estate investments. Now, if the market tanks or you have difficulty finding quality tenants, there's a chance you could default on the loan. Another negative is that real estate is not a liquid asset. Like I said earlier, it's not a liquid market. This means you probably won't be able to sell it quickly if you need cash in an emergency, which you could with a more liquid security like a stock, okay? Now, some of the bigger problems that I have with direct real estate investing come in the cons here, right? I think the pros were pretty straightforward, and don't get me wrong, I completely understand that if you have a long-term appreciating market and a place that you can set the rents and you can get the income, then that's fantastic, right? And one of the biggest problems that I have with real estate investing is the financing, right? The fact that you're going deeply into debt on places that you don't live in order to, make some type of return. And people say all the time, well, I can make better returns than the stock market in real estate. Well, of course you can, right? Of course you can, because of the leverage factor. Anytime that you lever up, it's going to magnify returns. Now, don't get me wrong, it's also going to magnify losses, right? The more leverage you have, you take losses get magnified too, okay? But ultimately, it's going to magnify your return. So let me just give you this example, right? Let's say you own a rental house, you own it outright, right? And then there's no longer a tenant in that house. Well, you don't have a mortgage. Yeah, you pay taxes and insurance on it, whatever, right? But you don't have a mortgage, so you're not really losing a ton of money on that house, right? There's no losses there, really. Yeah, you're losing the potential gains, but there's not really any major losses. But let's say you have a mortgage on that same house, right? And you have to make the mortgage payment on it, and then there's no tenant. Okay, now we're freaking out. Why? Because you were using what that tenant was paying in order to do what? In order to pay that rent. And that's a problem, right? That can be a problem for you. Now, many people would argue, well, then that's why you don't want to buy one door. You want to get a bunch of doors, and so it decreases your risk of not having tenants in place. Look, I get that, right? But I'm just saying at the simplest form, right? You can have as many doors as you want, but you're financing every one of them, okay? And so there is a magnification of losses by leverage, okay? But again, there's a magnification of gains because you are having to charge above the cost of taking out said loan, right? In order to, make some type of return on this particular investment. So it's beneficial if done correctly, but then what if negative things occur, right? What if negative things occur? What if losses do occur? What if you don't have the tenants? What if you don't have great financing terms and, it's a costly payment and whatever, right? Many things can happen that would just, really put a damper on your ability to directly invest in real estate properly. But if you're somebody who's got the time and you want to put the effort in, you want to put the energy in, you're interested in real estate, you can buy real estate with the money that you already have. You can pay for it in full and you're not highly levered in doing all of these transactions. Then I think this can be very, very good. It can be a very good way to build long-term wealth. But I do not think that the average individual should be doing this, right? And I think that's the common misconception, especially all these get-rich-quick people, right? Is that this is something that you can do or you should do. I'm not saying you can't, right? Of course you could, okay? But that it is prudent to do. And I would not suggest it as being prudent for somebody who does not have the cash to go and buy these rental properties in cash, okay? So, very simply, the pros and cons of direct real estate investment are simple. Pros, positive cash flow and appreciation, tax advantages, and control over decisions, right? You make all the decisions, you make cash flow, and you can decrease your tax liability. The cons, a lot of time and energy, right? A lot of hands-on work there. The risk of a financing default, right? You have risk there, especially if you are financing the purchase of the properties, which most people are. And then it's illiquid, right? If you need to buy or sell it at any given time, it's going to be very difficult to do quickly. And when I say difficult to do quickly, you may sell it immediately, but then there are, waiting periods with real estate and all that kind of stuff. Whereas with other types of assets, you can just sell them and immediately have the cash, okay? But do I think that's a bad idea? No, I don't. I just don't, I don't see it as realistic for a lot of people. And the reason that we're talking about this today is very simply for the idea of diversifying our assets, right? Having diversification of the things that we are invested in, right? And real estate is a place where a lot of people want to diversify into. And so they go and they try to get, into the direct real estate investing market. And it's just far more difficult than they ever expected it to be. So that's why we are comparing it with REITs, right? or real estate investment trust, right? REITs, right? The S is lowercase, right? But REIT is a REIT, right? Now, what is this? What is a REIT? Well, this is a corporation that owns, operates, or finances income-producing real estate or real estate-related assets. It's modeled after mutual funds. REITs pool the capital of numerous investors. Okay, today there are more than 225 REITs in the United States that trade on major stock exchanges and that are registered with the Securities and Exchange Commission, the SEC. These REITs have a combined equity market capitalization of more than $1 trillion, and worldwide, more than 35 countries currently offer REITs. Okay, so all a REIT is this securitized, financial instrument that actually does pool money and go and have the purchase of all of these income producing real estate assets, right? So basically, you're just pooling a lot of money in order to go buy real estate, but you're not making the choices here, which we're going to get to here shortly. Some portfolio manager or some person who operates the REIT is going to be making these decisions for you. Okay, which can be beneficial, but can also be a negative. Again, we'll talk about that in a moment. But these REITs are going to be far simpler to purchase and far simpler to get the diversification that you may want into real estate than are the direct real estate investing routes. Now, what are the pros? What are the advantages of REITs? Perhaps the biggest advantage of REITs is that individual investors can access profits from real estate without the need to own, operate, or directly finance properties, right? You don't have to go and buy a rent house or an apartment complex or whatever, right? You don't have to go and try to find ways to finance it. You don't have to operate it, right? Deal with tenants. You don't have to do any of that, right? REITs, they offer a low-cost way to invest in the real estate market. You can invest in a fund with as little as $500, right? A much lower entry point than direct real estate investing. And I say $500, you could actually invest in REITs for a lot less. So there are REIT index funds. So think of a REIT like a stock, right? It would be one specific REIT, one specific investment trust where they invest in certain assets, right? But there are index funds for REITs, right? Vanguard has one. This is VGSLX. It's the Vanguard Real Estate Index Fund Admiral Shares Mutual Fund, and it trades for $155.06 per share. That's a lot less than $500, and that's a lot cheaper than having to go out and get, all the financing, all those types of things. Now, the return's not gonna add up in the same way, right? The benefit's not gonna add up in the same way, but the time and energy that get put in is far, far less, okay? Now, another benefit is that REITs offer enticing total return potential, right? So again, the returns are different, but the returns may be enticing. By law, REITs have to pay at least 90% of taxable income to shareholders, and it's not uncommon to have a 5% dividend yield or more. So what's that mean? 90% of taxable income to shareholders means that all the net income of the real estate investment trust, 90% of it must be paid out to the investors. And a 5% dividend yield means that, let's say you pay $100 for a share of a REIT, right? Every year on average, you can expect $5 per share with a 5% dividend yield, right? So $5 dividend on a $100 stock or a $100 REIT in this case gives you a 5% dividend yield. Now, REITs also have the potential for capital appreciation as the value of the underlying assets increase, right? An important perk is liquidity. Like stocks, you can buy and sell REIT shares on an exchange. In general, REITs trade under heavy volume, which means that you can get into or out of a position when you want to, right? You have a lot of liquidity here. You can buy and sell very, very easily, okay? Now, again, I'll stand by this. Even though you can get enticing returns with REITs, the direct real estate investing market, you can get far better returns. Why? Because of the leverage aspect there, right? Now, what are the cons of REITs? I'm not saying REITs are the best thing ever. What are their cons? Well, of course, there are some drawbacks. For starters, most REIT dividends aren't considered what we call qualified dividends, right? So they are taxed at a higher rate. qualified dividends are taxed at a lower rate. And if you have a taxable investment account where you get dividends, you've probably seen this before. Now, this is something to pay extra attention to if you own REITs in a taxable brokerage account. But keep in mind that you can hold REITs in a tax-advantaged account like an IRA, and then you can not have to pay the taxes on those dividends. Now, another con is that REITs can be very sensitive to interest rate fluctuations, right? And rising interest rates are bad for REIT prices. Now, let's think about why that is. Well, quite naturally, the returns on investment for owning real estate will naturally be lower if interest rates are higher because they are financing the ownership of the properties within the REIT, right? So if it's more costly to finance the property, then it is going to decrease returns over time. Now, in general, REIT prices and Treasury yields, right, the U.S. Treasury bond yields, have an inverse relationship. When one goes up, the other goes down, and vice versa. Another drawback is that while REITs can help you to diversify your overall investment portfolio, most individual REITs aren't diversified at all. That's because they focus on a specific property type, such as offices or shopping centers. If a REIT invests solely in hotels, for example, and the economy tanks or people stop traveling like they did during COVID, you can be exposed to property-specific risks. Now, again, that's where something like a REIT index fund may come into play for you. But you can own individual REITs, and those individual REITs can have some outstanding returns over time. So, basic pros and cons of REITs. Real estate profits without having to own, manage, or finance the property, big pro, right? Higher than average dividend and potential for appreciation, another pro. They're liquid, meaning easy to buy and sell, right? Those are the major pros. Major cons, no tax advantages, sensitive to interest rate fluctuations, and they may have property-specific risks associated with them, okay? So this gives us this choice. It gives us this thought between direct real estate investing and investing in real estate investment trusts. Very simply, this is what I think. I think that if you are in a position where you have a lot of excess cash, you have the ability, the time, the energy, whatever, to invest in real estate directly, by all means, go and do so, right? I would totally suggest that. But if you are just looking for easy diversification and low cost diversification, and maybe you don't have a lot of excess cash, but you're investing and you want to do it as best as possible, you want the diversification into real estate, right? REITs are likely the best way to go for you, right? It's likely the best way to go about having access into the real estate market. Now, something that a lot of people don't take into account is that a lot of major corporations also own a lot of real estate, right? So if you own the stocks of major corporations, some of their underlying assets are real estate, right? So you may have a bit more allocation into real estate than you think that you do based on whatever your holdings may be in your investment portfolio, right? But I don't want to deter you from either one of these, right? I think they're both viable investment options. And I think they're both ways in which you can grow your money over time, no doubt, right? Now, do I think they should be the only way that you invest, right? Whether it be direct real estate investing or REITs, absolutely not, right? I think that you need to be diversified, right? Yes, a lot of people, they spend a lot of time doing real estate investing. They don't have anything in the stock market. I get it, right? But you bring a lot of risk associated with that, especially as you have, the leverage associated with direct real estate investing. That can just bring a lot of risk that is unnecessary when you could be diversifying into other assets, other companies via the stock market. But then especially with REITs, if you own REITs, my assumption is that you also own other things within financial markets, such as stocks, bonds, whatever else, right? So I do think real estate is a very viable area of investment. I think that it's made a lot of people rich, right? I think it's made a lot of people very, very wealthy. But it needs to be done in the proper way. We can't just look at all these people on social media and say, oh, well, if they did it in that way, then I can do it in that way. Or, if they got rich quick doing this, or if they took out all this debt and were able to be successful, then I can too. They may definitely be the exception and not the rule. And I would argue that they are, right? The rule is that going deeper and deeper into debt, even to purchase something like real estate, can be detrimental over a long period of time. You are failing to take risk into account in a proper way. And that's what I want you to understand. I want you to understand that allocating risk properly is a big part of our investing lives. Okay, people are in it for returns. I get it, right? Returns are one of the biggest things that we want to look at on a regular basis. But I want a good risk-adjusted return, right? That's the reason why we diversify. We don't diversify so that we can just decrease our returns. No, we diversify so that we can decrease the risk associated with our portfolios, right? We diversify so that everything in our portfolio is not just going all one way or all the other. It makes sense to do so, okay? But I would also implore you to invest in what you know, right? If you know the real estate market, if you understand real estate, you understand how it works, by all means. But again, if you don't have the money to do it, then you just don't have the money to do it, and it may not be the best avenue for you, right? But if you don't understand real estate, you don't understand, being a landlord, you don't understand, the tax implications, you don't understand all the work that you're going to have to do, then don't do it, right? There are far easier and less intensive ways to go about investing than direct real estate investing. But by all means, diversify with some REITs, do whatever you need to do in financial markets. So those are my thoughts. But the bottom line here is this. The bottom line is direct real estate investing may be a better choice if you want cash flow, if you want tax breaks, or if you want great potential for appreciation in real estate. It's also good if you want more control over your investments and you like a boots on the ground approach. And this is something that I think a lot of people love. A lot of people love having their hands on their investments. They like to drive by it and be able to see it. Right? They like to know it's there, not just pull up an investment account and see that you own this stock or this fund or whatever. And then REITs make sense for investors who don't want to operate and manage real estate, which the vast majority of us do not, right? As well as those who don't have the money or can't get the financing to buy real estate. REITs are also a good way for beginner real estate investors to gain some experience within the industry. And that's something that I've left out. But if you don't have the money yet, you're not in that place yet, or you're trying to learn how things work, then REITs can be a great place to get started before you ever move into some direct real estate investing, right? You can learn how you're getting the returns, why you're getting the returns, and ultimately what it looks like to invest in real estate in your own portfolio, right? So hopefully this is helpful to you. Hopefully I can help you guys to be better investors. Real estate is not an area that I allocate a ton of money to, right? But I think that a lot of you may really be interested in it and really want to put money there, but you need to be prudent. You need to be thoughtful about what you're trying to do in your financial life. Know what your goals are, know what the plan is, follow your investing strategy, and you will be fine. Don't veer from your investment strategy just to try to get involved in something that your friends are getting involved in, or that somebody says you can get rich quick using, right? So hopefully this is useful to you and get you more interested in how you can get allocation into the real estate markets in your investments. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think can be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.